This is Housing Houston. I am your host, Mariela Aguirre with Terra Residential Services, and this is episode 2.
And I am your co-host, Kayla Ewald with First American Title, and we are so excited to be here again with you today, along with our special guest, Ben Sinclair with Highlands Residential Mortgage. Hey, Ben.
Hey, Kayla.
How you feeling?
I'm good. I'm a little nervous, but thank you for having me.
Don't be nervous. We don't bite.
All right. I know.
We don't bite.
I'm just worried about the questions.
We don't have any questions here. We just want the value that you can bring to the table for the real estate agents and the consumers. So why don't you start off with just telling us a little bit about yourself?
Okay. Like I said, I'm Ben Sinclair. I'm with Highlands Residential Mortgage. I've been in the loan business, moved to Houston from Fort Worth, Texas. Go Frogs, in 1996. Started out as an underwriter, learned the technical side of the business. Eventually, I talked too much and they ran me off and said, go originate loans. There's nothing better than getting somebody into their first home or any home, but especially first-time home buyers. I really like that. Some of your first-time home buyers turn into, second-time home buyers, investment property home buyers, et cetera. And I've been doing it long enough to see that happen, with some of my borrowers 3, 4, 5, even up to 6 times. So that's how I got in the business. I've always had an affinity for banking and finance, and mortgages was where it's at when I was younger, and I'm still doing it today.
1996, you guys. So whenever you are looking to buy a house or you're a real estate agent looking to have a lender as part of your team, he's going to be somebody who's been around for it all. I bet you've seen all market conditions.
Yes, we've been rich. We starved to death in 08. It's definitely
if
cyclical.
You know.
Yeah.
And it's always going to cycle. We've had way more good years than bad. If those of you out there who are straight commission people, you understand. You make more money in the long run, but you gotta endure the slow times.
So
for sure.
Speaking of the market conditions, why don't we talk about what you're seeing in the market now as far as from a lender standpoint, interest rates?
From a lender standpoint, the Fed has been talking about rates going down the entire year. Thus far, they have yet to cut the Fed funds rate. And that's the rate that that pretty much dictates what all the rest of the rates are going to be. We've had some good signs recently. Unemployment's been rising slowly. Good signs for lower rates. I know that's not good signs for the people that don't have a job, but the Fed, the economy is what's driving rates. Inflation was too high. It's coming down. So we're thinking, everybody's predicting that the Fed Reserve is going to lower rates at their September 18th meeting.
Okay.
They're having one in August, I think this week actually. So it could happen this week, but nobody's thinking that that's going to happen. I think they're going to wait one more week. We've got jobs coming out this Friday. The Bureau of Labor and Statistics releases those numbers this Friday, and that's a big number for the Fed. If we see a weakening in the job market, along with inflation coming down, which it has been, we're probably going to get lower rates. Now, you have to put it in perspective. When I started in 1996, 8.5 was a good rate. Mm-hmm. So, so we're in the 7s, mid 6s now, depending on your credit score, et cetera, loan to value, things like that. A loan officer can't really answer the question, what's my rate going to be, until they have a loan application. But they have eased a little bit, but they've basically stayed in the same place all year. And we're hopeful that we'll get a cut in September. And then maybe after the election, we'll start going the right direction.
So after seeing what's happening in the market, and because that interest rate has always been the hot topic right now between even investors, which is who I'm mostly involved with, but also first-time home buyers, what type of lending options have you seen more of because of the interest rates?
We've seen, we do a lot of down payment assistance for first-time home buyers.
Okay.
We've seen 1.0 and 2.1 buy downs where your rate is, discounted a point the first year or maybe for 2 years. We've seen a lot more of those. It makes it a little more affordable. Depending on your loan balance, it could save you $300, $400, $500 a month. When you do a buy down, the good thing about a buy down is the buyer cannot pay it. The lender can pay it, the realtor can pay it, but the buyer can't pay it, which is a nice thing for the buyer. But it saves them money the first year, and the hope is that by the time it adjusts back up, that rates will be lower. So we've seen that. We do a lot of down payment assistance. I'm married to a lender who's a champion of first time home buyers and down payment assistance. So I've learned a lot from her over the years. And we've just, had to get creative a lot of times, whether it's with a first and second mortgage combined, or, just pre-approving people that think they want, they don't qualify for a really high price point home. So we've looked for diamonds in the rough, maybe, and done some, some loans that have rehab components to them, that have a construction rider, where, they buy a home for $250, but their as repaired value might be $325, and we roll all that into one loan. So those are some things we can do. Because it's not just interest rates now, it's homeowners insurance. And with property values being high, that dictates what your property taxes are. So all three of those things have been really tough for our first time home buyers. We're seeing a little more inventory, and we're also starting to see seller concessions for the first time in probably 5 years. Okay. So, and that's good for, for buyers, to help them get in for cheap.
For sure. And so that applies mainly with first time home buyers. So the biggest tip out of this is, now is the time. I know we mentioned this in the first podcast, but now is the time to at least get set up and ready for, if these interest rates, if they come down significantly, at least you already have your application on file. You already spoke with your lender, and you can already get the ball rolling to the point that you have your pre-approval letter, and let's go. Let's work with the agent and find you that home.
And what I'm hearing out of it all is experience matters. I mean, 1996, he has seen it all. He has been through it all, and he knows these options. I'm not saying working with a new lender isn't maybe the best fit for you, but do you hear all of these options that some lenders might not even know they have, with the buy down options, the down payment assistant? And he is married to a loan officer who does that all the time. So really, you want to talk to somebody who's going to be able to find good solutions for you when buying a home.
100%. Yeah. Finding someone that has the resources readily available, and has the experience, so that you're not paying for mistakes that a new lender, for example, would make. So that is really, really important when finding a lender that has that experience and knowledge already. And so with that, since we spoke about first-time home buyers, what about us investors? Yeah, I can't forget about us, so we are also hunting for those great opportunities out there. And so I know if the numbers don't work, it does make it difficult. So finding also a program that a lender can provide you with more tools under your belt. And what would you say for those investors? What would be a good strategic position?
And do you work with a lot of investors?
I do work with, I'd say, a fair amount of investors. Like I said, a lot of my clients have become investors. And that you have to, it's tough on it. The same things that make it tough on a first-time home buyer make it tough for your properties to cash flow right now, right? And so you pay more attention to things that, like 10 years ago, you didn't care how old the roof was, because your insurance was cheap. Right now, if you've got a 15-year-old roof, it might be the difference between $2,000 a year and $5,000 a year, and just homeowners insurance premium. But that all goes into your cash flow analysis. So the one thing I would say is, if you're an investor, you may be prepared in this market to be a little tighter, to maybe just, zero, because, and this is what I think is going to happen, is rates are going to come down. We don't know exactly when, but when they do, demand's going to go up. And I don't think house prices are going to really they've kind of softened and leveled out. They're probably worth what they should be right now, but I don't see the market, some people are like, we're going to have a correction. I don't see home values going down, by 100,000 or anything soon.
Right.
And if you buy a house at, say, 300 now, an investment property, and you finance it at, say, 7.25, that same house, a year and a half later, when, say, rates are 5 3/4, but now it's worth 350 or 375, you got to pay for it. Well, your payment's higher even at a lower interest rate, because you had to finance more, you had to come out of pocket more, your taxable value's gone up, all that stuff. So that's we've had the cost of waiting conversation a lot of times this year. And some things coming, like conventional loans, Fannie Mae, Freddie Mac. They just changed, or it's actually next month. You're going to be able to put 5% down on a duplex, triplex, or fourplex.
Can we get a round of applause?
We're excited for that.
So you don't have to go FHA to get a low down payment, because PMI never goes away with FHA. So those, and the previous was, if it was a duplex, you had to put 15% down, and if it was a 3 or 4plex, a fourplex, you had to put 25% down. So they wanted to kind of give more people access to, affordable rental properties. And when you're buying a duplex or a fourplex, remember, you can, in a lot of cases, you can use the income on those other units to help you qualify. And that's a nice thing for investors, and it also, if a one unit doesn't cash flow, well, maybe a 2 or 3 cash flows a little better because you got more potential for income coming in. So that's something we've talked about with our investors too.
Perfect. Yeah. And so as you can see, this is why we have this partnership, between a property management company, a lender, and a title company who can really guide you through getting successful investment properties, or even if it's just a first-time home buyer situation where they can totally take care of you. This is why we have partnerships.
I want to break it down just a little bit for the consumer. I want you to talk about who the Fed is and why they come into play so much. And then loan to value, you mentioned that a couple times,
Right.
and the credit score, and maybe some tips and tricks they can use for those. So if you don't mind,
I don't
can
mind
you?
at
Okay,
all,
good.
So
Okay, good.
Who
I'm
is
listening.
this
So
Fed?
I'm like, okay, real estate agents out there, you're familiar with this lingo, but
Right.
for the consumer itself, let's talk about the Fed credit score.
The Federal Reserve, right? It's a group of bankers, basically. They call it Board of Governors, and I should know how many there is, but I can't tell you off the top of my head. But Jerome Powell is the head dude at the Federal Reserve, and they meet periodically throughout the year. And they set the Fed funds rate, and that's the rate that banks loan to each other overnight.
Okay.
And then the prime rate comes from that, and everything else follows the Fed funds rate, right? So when you hear, they're going to drop interest rates, that's what they're dropping. They're dropping the cost it costs banks, but everything else follows that, and it affects bonds, which mortgages are traded off of bonds. But that's the Fed, and the governors, they have press conferences throughout the month. The Federal Reserve governor from Kentucky will be talking, and Powell's going to speak this week. But if you just Google it, it'll kind of give you some info on that. But the Federal Reserve kind of dictates, and they're responsible for not letting inflation get out of control.
Okay.
And trying to keep the unemployment, low. And not letting the economy heat up. And the reason rates are high right now because inflation got out of control, and you stifle the economy when you raise interest rates, and that's what they're trying to do, slow it down. So everybody's been to the grocery store, right? Where we don't want to pay $8 for a loaf of bread, we want to pay $1.50 for it, and that's what they're trying to accomplish right now. Loan to value, that was the second thing, right?
That was the second thing.
Loan to value. You have a house that's $100,000, right? If you put 5% down, your loan to value is 95%. So your loan amount on that 5% down would be $95,000. You divide 95,000 into 100,000, you get 95%. That's what your loan to value is. Your equity is that 5%. If you don't want PMI on a conventional loan, you put 20% down. So that'd be $20,000 on your $100,000 purchase, and your loan to value will be 80. Just 100 minus the 20% gets you to 80%. So that's what loan to value is. And the third thing,
Credit. And I know you work with some credit repair companies when they need help. And
we do.
we
We've got some that are fit for everybody. We do some small credit repair ourselves. If it's easy, we've been doing it a long time.
What credit are you looking for when you're?
Like for a conventional loan, you've got to have a 625.
Okay.
FHA, we can go down to 580, even lower, but it gets difficult. When somebody says they'll do an FHA loan at 540, it's possible, but it's hard. And you got, you can do 3.5% down on an FHA loan above 580. You got to put 10% down on an FHA loan below 580. So it gets advertised one way, but when you get into it, there's catches as your score drops. Bottom line, the higher your score, the better your interest rate, the better your terms for the loan. FHA is not as sensitive. Government loans, VA, FHA loans, we do a lot of VA loans too, are not as sensitive to credit score as conventional loans. But if you can get your score up to 780 or above, that's where you want it. You're going to get the best rate, the best terms. You need one installment loan and 2 revolving trade lines to get your credit going. So a car payment or a note loan at the credit union and a couple, a Chevron card and a Kohl's card works, or a Visa. If I have people tell me, well, I wanted to pay more, so I waited and was late on my payment. If your payment's $15, make the $15 payment, because your credit history is like 35% of your score.
Mm-hmm.
They're going to look back and, those student loans that maybe once upon a time I missed a couple payments on didn't help my credit score. You know, and that stays with you for 4 or 5 years. Now, recencies too. If you have a recent late, your score's going to drop.
Okay.
If a late from 6 years ago, it's probably not going to affect you that much. But you just, you know, if you take care of the business, honor the commitments that you make with your creditors, you're going to, your score will go up. I mean, it will, and it takes, I've got a kid in, outside of Beaumont somewhere right now, and he wants to buy a house. His parents are helping him, but they want him on the loan. He had no credit score. It took us about 4 months
Okay.
to get him a credit score. You can also be an authorized user on your dad's account or something like that. That'll help your credit score as long as their trade line's good. So there's lots of things we can do. The bottom line is find a loan officer who's been doing it for a minute. And you gotta, it's free to get pre-qualified almost always. And you got to find out where you stand to make a plan.
Yes, that's
know.
good.
Yeah.
All right. Hey.
New
So,
tagline.
you know, and sometimes
That is a great tagline.
You know, sometimes you don't know. A lot of people come to me and they don't think they can buy a house, and they can't. You know, or they're not. And we try to never say no. We try to say, okay, Kayla, you're not ready today, but if you do this, this, and this, call me in 3 months. We'll run it again. We do soft pulls, so we don't hit you with a hard inquiry now.
And I will say he is telling the truth. I have a colleague that used Ben to buy a house, and she wasn't ready at the time. And Ben's whole experience coming into play with the plan of what she needed to do over the next year.
Yeah,
Was it a
at
year,
least
year and a half?
maybe longer. Yeah.
And she was so thankful because she now knew what she needed to do to become a homeowner. And they walked through it, got her into a house, and she's doing great. But he really means that. He's not just going to say no, he's going to walk you through it.
No, those are great. I had a lady that she retired from the state of Florida, and she was working at MD Anderson. That's when I found out you can walk like 7 miles to get to it, because we closed at MD Anderson, but it took me 2 years to get her loan ready.
Oh, wow.
And, you know, she'd never owned a house. She was in her 60s. And, you know, it is a gas when you get a first-time home buyer, 67 years old, the grin on her face.
Oh.
Like 3 months ago, I put
That's
a
why we
veteran
do
in his
what we
first
do.
house. He was like 50-something. So, and be prepared. It's real estate. It can be a little bumpy,
Yeah.
you know, as you go down the road, but it ends with you getting a set of keys and a home.
Yeah.
So just remember that's the goal, and it's the quickest, easiest way to build wealth in this country, bar none. You got to pay rent either way. You might as well be paying your own rent and building equity.
For sure. And so with that voice of experience, you have seen all sorts of markets, and the infamous one is 2008. So for my young people that have never experienced that because they were in school, in middle school or high school,
Yeah, I know.
you know, so guide them through what, in an overview, what happened, and that's why now we're being impacted today because of that.
Well, and the 2000s, that's when I left, you know, the bank and became, you know, started to speak. I became a straight commission person in 2003, and we could do, if you could breathe, if you could fog a mirror, we could get you a loan, Mary Ellen. And I mean, credit scores down to 500. We did stated income loans where you don't verify income, you don't verify assets.
What?
Yeah. It was
Which is why 2008 happened.
Yeah, you were practically giving loans like candy. That's what it was.
Here's the house. Here's the house.
was.
Everybody gets a house.
And it was the demand on Wall Street, you know, was such that they just wanted loans, so they kept lowering the standards. The loans we've been making since 2008 are pretty good loans. We don't have the quality problem, but so it led up to that, you know. And I went through formal credit training at a bank, and they taught you, if, you know, would you make this loan if it was your money? And there's a bunch of them I made in the 2005, 6, 7 that if it had been my money, they'd have had to find somebody else to get it. Because, you know, it didn't make sense. But, you know, if I didn't do it, somebody else would. And eventually the bad debt caught up with them. You know, those loans started going bad. Builders started losing their lines of credit, which
Because
is how
they
they
couldn't
build
afford it.
houses. Banks started getting skittish that they were going to have, you know, all this money out. That I had a warehouse line, which is how we fund loans. I was a little independent shop back then. I'd never messed it up. They yanked my warehouse, funded a loan, and the next day I had no warehouse line.
Wow.
If you're a Houston person, I funded a loan in Sweetwater down the street from David Carr. And it was like my biggest loan to date, and it worked perfectly. We closed it, and the next day they called us and said, you know, your $2 million line of credit's gone.
Wow.
And everything just kind of imploded, and all the subprime lenders, which is not Fannie, Freddie, FHA, USDA, or VA. It's the subprime guys. They I bet 90% of them went out of business. Literally within about 6 months. There was a website called mortgageimplode.com. We'd pull it up every day, and there'd be 5 more people on there. It's like, I used to send loans there.
Wow.
So it just, and then we started getting some government assistance in 2009, and it really, the market rebounded. It leveled off. It was probably as close to equilibrium then as I've seen it as far as being buyers, sellers. And we were prosperous up through the pandemic. And then, the pandemic, rates went from the beginning of the pandemic, rates went from like maybe the high 4s to 3 overnight. And that's not normal. Usually it's a graduated thing. We had these 3% interest rates, which all the guys older than me that were my mentors said, we'll never see 2.5 or 3%.
Mm-hmm.
We did. We actually saw that. And we've got a whole group of borrowers that think that, 3 is a normal interest rate. Well, if you look back over time, it's like 7.1 since they've been tracking it. So, but 2008 was a big crash. We went from, we had a hurricane that year. Rita came in, or the next year. Some of the insurance money getting back into the economy helped kickstart things around Houston. But it was bad lending practices. If y'all ever if you want to learn more about it, watch The Big Short. It's pretty good movie about it.
And you might nowadays find a couple of those lenders out there still that are like, oh, I can approve you for 400,000, but really you can be approved for 400,000, but you probably shouldn't be approved for 400,000.
Right. You don't want to be house poor. I can get you into a house that, your payment's $5,000 a month and it's beautiful, but you can't leave because you can't afford gas for your car or to go out to dinner or anything like that because your house payments.
And you go over those things with them too.
Yes, we don't want you to be, we want you to be comfortable with the payment up front going in. And we don't want you to go shopping for $600,000 when your appetite for a payment is a $425.
Right,
exactly.
Because it's hard to go down. And what we can do, and we put, I guess for the first time home buyers, we've done more parents as non-occupying co-borrowers in the past probably 18 months. And that's basically when your parents co-sign for you. It doesn't even have to be a parent. But there's ways to get in. And I always say if somebody's committed, usually within a year, we can get them in a house.
Okay. For sure.
Yeah.
Pretty much.
Very cool. Oh, that's awesome. Yeah. And so as you can see, the intel here that we have in front of us is so prime. And so with that also comes the another infamous, phrase is the market is going to crash. So in your professional experience with your line of work, do you see that happening this year?
I don't see it happening this year. I mean, the real estate mortgage business always cycles, right? It's and there's statistics out there. I forget, for every 8 good years, you have 1 bad year or something like that. But, Texas, I think 1 in 3 jobs created over the past 2 years was created in our great state. So people are moving here. Yeah. We've got unlimited room to grow out. California has to grow up because they've built on all the land. Texas doesn't have that problem. They've got a lot of land, a lot of room for expansion, and a lot of jobs. And so people are, and Chicago's a beautiful town. I've had a great time every time I've been there, but I was always, I don't want to live somewhere where it's 20 degrees all winter. And a lot of people, I think, have that same, are coming this way, and we have no state income tax. So we're going to have demand for our housing here. Like I said before, the cost of waiting, I think if rates drop a point from where they are today, that, I read a statistic that puts like another 1 million buyers into the market.
Wow.
So, and with more demand, that's an upward pressure on house prices. And you'll see we've got a little more inventory than we've had, and you'll see some people saying house prices come down, and they have, but they were overvalued because of the pandemic.
Right.
People were paying $80,000 over list and not even batting an eye. And that's not happening now. There's a negotiation going on. A good real estate agent is crucial in your home buying journey.
And what I'll say to that is marketing matters now more than ever. So look to see where the developing cities are. Where are people relocating from? Let's start being strategic with marketing and your farming and prospecting, and get to where you need to go, to where in 6 months to a year, when people are buying here, they call you. And if you need help with those kinds of things, get with me or Mariella, and we'd be happy to help with that.
And one thing I'd like to say, like especially on Mariella's behalf, is working with investors. Just most investors, their first investment property was their primary residence at one point.
Absolutely.
So you can build it that way. You can buy a primary, you live in it for 3 or 4 years or 2 years, or however long, and then your family grows, or your job changes. Just keep your financial situation at a point where you can qualify with both mortgages. You move to the new one, you buy a new house, keep the old one, and it turns into an income producer for you. And somebody else is paying off that asset, and you're building equity without even making the payment. So, you don't have to go out and buy 5 investment properties at one time. You can build it, and a lot of people have, one step at a time. And it just started out almost accidentally when they said, well, we like this house and we don't want to, sell it before we move. And then they talked to an agent and they said, well, you can get $2,000 a month for this. And you're thinking, wow, my payment's only $1,500.
Mm-hmm.
There you have it, an investment property.
Exactly. Yeah. And that's personally how I started. Was purchased my first property, ended up living in it for a couple of years, and then my situation changed. I ended up having to turn it over to a rental property, and now Tara's managing that property because I'm not going to do that. And so, and there's so many ways to get started. And starting off with your primary tends to be the best case scenario because of just your financial situation and the lending program that you can get.
And a lot of people inherit them too. If somebody passes, you inherit a property. Well, the first thing you want to do is sell it. Well, it might, you might look at the long-term benefits of having it, getting a check from it every month. That's another way to get investment property.
Great options. Find out what your options are.
Absolutely.
You are a wealth of knowledge. Yes. Oh my goodness. All the things. This is only a tidbit. So get with him if you have any other questions. How can they contact you, Ben?
You can always reach me at my cell phone, which is 713-412-3709. My website is sinclairloan.com. And my email is bsinclair@highlandsmortgage.com. But if you get the cell phone, that'll get us started. I'm fully up to speed, even though I look like I started in '96 with technology. You can sign your docs with the phone. I've started doing hybrid closings where you only sign like maybe 3 things at the title company, and all of it, the rest of it's signed before.
That's nice for us.
Yeah, it's you don't spend, and I would love to spend an hour and a half with Kayla at the title company because she's wonderful, but. If you
probably still would, even though the documents are all signed, we would probably still sit there.
If you're in a hurry, we can get your closing at the title company down to about 20 minutes.
Yeah,
that's something new we've started. So we try to stay ahead of the curve on that. Just life happens fast, and a lot of people I think fill out their loan application while they're laying in bed with their cell phone.
Absolutely. We will make sure that all of his contact information goes on this video. Make sure you subscribe to us, Housing Houston. Again, I am your co-host Kayla Ewald with First American Title,
and I am your other co-host Mariela Aguirre with Terra Residential Services. Thank you so much for joining us.
Thank y'all for having me.
Thank you.
Thank you.